If you're building a portfolio, you want to avoid concentration risk. You will want to ensure that you are diversified. Today, I have my guest, Geoff Sokol from GT Investment Management joining us, who is going to talk about diversification. Very excited to have you on the show. Thanks for joining us, Geoff.
Thanks, Tim. Glad to be back on the show. And this is an important topic. I was just chatting with someone who didn't diversify away his risk and he was over concentrated in his company. So this is fresh on the mind and I'm excited to share it with our viewers. Just so everyone is aware, we're going to talk about some really exciting investment opportunities, such as human emotion. You might want to hop on the phone right now and go buy something or sell something else. Don't do that just yet. Make sure you work with your wealth advisory team to discuss if it makes sense for you, because all we're trying to do in this video is get you excited about the idea of de-risking and diversification. So please do reach out to us if you'd like to have this conversation on a deeper, more personal level, but nothing in this video is personal investment advice for any of you.
Before we get into this, can you give the audience a very brief definition of what is diversification?
So this topic became exciting and became more mainstream in the past couple of years when Tony Robbins wrote a book called The Holy Grail of Investment. And it's a topic that he got from Ray Dalio, who is one of these, he's like a Mount Rushmore type of investor. And his idea was if you have 8 to 12 different types of investments that can perform, one can go up, one can go down. That's what we would say they're not correlated to one another. Then through thick and thin, through up and down, whatever happens in the market or business cycle, there are going to be pieces of your portfolio that perform well and you can never get taken out of the game. So whether it's, a financial crisis or a type of bank failure, whatever it is, you're going to be insulated from this risk and in a position of relative strength, whatever happens, so that you and your family will always be taken care of.
So what would be some examples of diversified stocks?
If we're just looking at an index, you might say, okay, I have this over concentration in technology right now. I've done well there. Maybe it's time to rebalance and go somewhere that's a little bit less exciting. And then we might say to go into a section called consumer staples. And these are places like Home Depot or Walmart or Target, where, maybe I don't want to buy as many new computer products, or I don't need as much cloud storage, or, whatever Microsoft or Apple is trying to sell me, but I always got to eat, right? I always need, some new clothing, or I need clothing, housing supplies. So certain areas are always going to perform better. And then that's how you can, diversify from one sector to another. But what we want to do is go a couple steps further to where we might be tapping into different markets, different countries, and different types of assets altogether, where we're not just looking at, Target versus Amazon, but we're thinking about could be owning a racehorse or a collectible item, or, things where you can really get creative to make sure you're very, very thoroughly diversified.
Yeah, and at the top of this, we're talking about consolidation risk. What are some examples of consolidation risks that you see? Practical examples, right? I mean, obviously, we can think maybe someone is 90% invested into real estate and that's where it ends. Well, there would be some consolidation risk in that. But what about other types of consolidation risks that you see out there?
The main one that we see is we're talking to a business owner, and this is a theme we see with entrepreneurial people's the entrepreneurial spirit. They've been told so many times that it's too risky, it's not going to work, and they just kept betting on themselves, and now they made it. And now people are telling them again, take some chips off the table, let's diversify out of, you don't want to hold all of your net worth in your company. And they have that gut feeling again, like, don't tell me what to do. I've made it this far. I'm going to keep doing it my way. And God bless him. But when you're so concentrated in your business, it's just the sort of thing where if an exogenous event takes place, like it could be COVID, for example, no one has any control over it. It just happens, it comes out of the blue, and the value can be gone. Whereas if you had just done something like a minority deal to issue, 5 or 10% of your company out through an equities, or, however you want to do it, you could then flip that over into stocks and bonds and real estate and other asset classes that are going to hold up. And then if something does happen to your business, there you find yourself in that position of relative strength because you're able to diversify out of the over concentration in your business.
Yeah, then that's a common one, the betting on yourself, which you have to do as a business owner, but you also need to take a moment, take a beat, pause, look at your long-term plan. We had talked about this in the past. find opportunities to diversify. It doesn't even mean you necessarily have to sell stock in your company. You could just take some of those company profits and personal distribution and dividends and things of that nature and diversify from there versus buying another motorcycle or a yacht, correct?
Exactly. And it's a common conversation. I'm sure you've had it too, where the business person says, if you want me to invest, I know where I'm going to invest in myself. And, we don't want to talk them out of that way of thinking because it's gotten them this far. And you have to have that type of spirit to keep going in this world when competition is always fierce. But like you said, we can look at your cash flow. We can find some way to pull some value from somewhere, whether it's income from the business or, whatever it is. And let's just put it somewhere that's going to perform well, and we know that it's going to perform adequately for years to come so that you and your family are taken care of for this generation and beyond.
What do you say to those people that say, I'm completely diversified. I have 100% of my investment in the S&P.
Yeah, these are tough conversations to have. On the one hand, what I like to do is I'm not really in the business of changing people's philosophy or ideology or I don't argue. I think that's the best way to put it. I'm not having a philosophical discussion. What I'm going to do is put these different items up on the board and show like here's what you're doing, here's what I'm suggesting. And then we can run simulations what this looks like in 1 year, 5 years, 10 years, 50 years, and what it looks like if we rebalance periodically, what it looks like if the market is extremely bullish, what it looks like if the market is extremely bearish. And we can look at it to say, this one does better than the other. I'm in the world where we have numbers. So instead of arguing an emotional topic, I can just say, this works 99 times out of 100. This one works 50, 60, 70 times out of 100. You know, you,
Yeah.
you can't argue with that. And if they
No.
still haven't changed their mind at that point, then, Godspeed. I'll still try and make the pitch, as much as I can. But I hate getting the call once something has gone wrong and they say, Geoff, is it too late to do this? And then, we'll see what we can do at that point. But, it's better to be ahead of the curve.
Right. And it seems like there's so many alternative investments out there these days. Some sound even a little crazy. You have your NFTs and you're mentioning racehorses, like fractional shares of art and rare watches and things of that nature. So getting started in diversifying is kind of a daunting conversation because you have the traditional way to diversify. I was mentioning S&P and other vehicles like that. And then you have all these ancillary opportunities that are coming for your pocketbook and your investment money. So where does one get started? How does someone begin to even get into the conversation of diversification?
It's a good question. I think the jumping off point is understanding you're at a different stage than someone else and just looking at your own circumstances and let's go from there. So let's say you're the type of business owner where you're 100% all in on your own business. Okay, that's a starting point. Let's sit down and let's just build you an investment portfolio. Something nice, easy, traditional. It could just be the classic 60% S&P 500 index fund with 40% investment grade bonds. From there, you know, a couple years down the line or whenever it makes sense to do it, then we can look at additional alternatives. But it's the sort of thing where, we want to do it in stages. Let's start with, when you get to the mall and you want to find where the Foot Locker is or whatever you're looking for, you need that directory that you are here. And it's like, okay, now I know what I need to do next. And let's just take it one step at a time.
Yeah, that's a great point. And that's great advice. I love the analogy of you are here because if you think about a mall's a pretty big place and you could be here in a lot of different places in that mall. And it's the same thing in life. And there's so many different factors that will determine your risk profile and things that we talk a lot about on the investment side.
So this is from UBS. This is for their family office, and this is with their private wealth clients. So typically these are entrepreneurs and business owners. You can see the breakdown here. 58% traditional asset classes. So equities, this is like your S&P 500. And then it breaks down even further. Developed markets. So we might think of the Western world, United States, Europe, Australia, for example, and emerging markets. So you're diversified not just in the S&P 500, but it goes another step further into developed markets and emerging markets. And it does the same with fixed income, your bonds, and then it goes into these alternatives where you'll see private equity so that you could invest in other entrepreneurs, people who do similar things to yourself or work in different industries. It goes into real estate and a couple of other items. So this is just a breakdown from their data. That was from UBS. We have this one from JP Morgan, and I thought this was interesting because the breakdown for their private wealth clients, they have an even larger exposure to private equity than they do to public equity. And we tend to think the reason for that is people like to invest in other entrepreneurs. One of the big things is the storytelling element of your portfolio. When you
Mm.
think of investing in the S&P 500, it's kind of a passive process, but knowing, hey, those guys are really trying to disrupt a new industry. They're going to provide a lot of value to the marketplace. I want to be with those guys. And, sometimes it's just about what gets you excited in terms of what you want to invest in. And there's a couple more I want to show you, and then we'll get into it. This is the family office allocation, and here are some of the items we're going to talk about today. I've got commodities circled because we might talk about gold and silver at one point here, but just to see, the different breakdowns. Another one from UBS here, and then this last one to get into the topic of rebalancing. This is a big one because once you have this, like Tony Robbins and Ray Dalio would describe, this holy grail type of investment portfolio, you can see all these different types. We've got gold, the S&P 500, commodities, real estate, cash, and so on and so forth. What you want to do is you can see, there are assets that perform really well and assets that perform poorly on an annualized basis. So the idea here is every year you're going to have a chance to what we say is buy low, sell high. So, in a year where gold does really well, you take some profit here and you can reinvest it somewhere that hasn't performed as well. So maybe, you take some profit out of gold, you put it more into real estate. And then there are years like in 2021 where it was the opposite. You could take some money out of real estate and put it back into gold. So this is that idea of relative strength where anything that happens that damages one part of the portfolio, you still have that ability to rebalance and get yourself even further ahead than you otherwise would have been by just being passive.
I love it. It's very, very comprehensive. All right, so that looks very comprehensive, what you just shared. Are there any tax implications or tax benefits to some of these investments and being diversified?
Oh, I'm glad you asked because some people might be familiar with the concept of tax loss harvesting. And it's crazy to think that we do this, but if you can believe it, we'll implement strategies to try and offset capital gains with capital losses. And people, they might have invested in Microsoft and Apple and Nvidia 20, 25 years ago, and they don't want to take profits because they know the tax ramifications are going to be severe. So what we do is we tax loss harvest to get capital losses to offset the gains, and we end up having to submit 1,000-page report to accountants. And boy, we'll do it for people, but there is a better way. So I'm glad you asked because the first idea I wanted to talk about is about real estate, and there are benefits associated with real estate, but there's one in particular that blows these other options out of the water called opportunity zones. Okay, so I'm looking at taxpolicycenter.org here. What are opportunity zones and how do they work? And let's just fast forward down to this part. This is the key point. Permanent exclusion of taxable income on new gains. For investments held over at least 10 years, investors pay no taxes on any capital gains produced through their investment in opportunity funds. All right, and if that sounds too good to be true, we'll hear it straight from the horse's mouth here. You can check this on the IRS's government website about how to invest in these types of qualified opportunity zones. All right, so what you can do instead of unwinding this position in Nvidia and Apple and Microsoft is you can deploy those capital gains into an opportunity zone that is a type of real estate investment that if you keep it there for 10 years, when you take that money out after it's appreciated, you never pay any capital gains or any taxes, not on the stock unwind or in the appreciation of the real estate. And this can be any type of capital gain. It can be from stock, it can be from real estate, it can be from, anything that you've flipped from one cost basis. If you've doubled it, tripled it, 10x it, whatever it is, as long as you declare it on your taxes and you flip it into an opportunity zone, it's like doing the 1031 exchange people might be familiar with from real estate, but it's like that on steroids. Any type of capital gain can avoid taxation and then grow further in the opportunity zone and never be taxed.
That's phenomenal.
The second one I want to show here is called a secondary fund. Okay, this is a partner of ours called Flowstone Partners, and they have a type of fund that we like, which is a secondary fund. And the way that this works is they have active managers that are investing in private equity projects, but they're doing it with a very specific focus. All right, so you'll see how that benefits a secondary as opposed to buying out a company or a fund of funds or venture capital, because these have a higher rate of return. So that's the first selling point. Obviously you want to invest somewhere that's going to appreciate faster than the other types, but these have more benefits, starting with the standard deviation. This is an important one because a standard deviation gives you the amount of volatility you can expect, and it's actually less volatile than the S&P 500 has been in the past few years. Some people might remember the challenges of a market like 2022, where stocks and bonds both got wiped out, whereas a secondary fund experienced less volatility. So this is that idea of relative strength again. When you go to rebalance the portfolio, you can feel pretty safe that here's a location that's going to be holding up better on a relative basis. And you can actually track that because they have a lower default rate. They're really hand selecting the best of the best, as opposed to venture capital where they're gonna invest in 100 different companies and hope for that one unicorn. This is a much different approach. And here is my favorite slide, because we're looking at the S&P 500 and the world stock indices. We have COVID and we have the global financial crisis. You can see down 20% during COVID, down almost 50% in 08, 09, whereas these secondary funds only down about 6 and 5% respectively. So that's the idea of this rebalancing. And we had this Japanese yen carry trade unwind, and there was all this madness in the market just a couple of weeks ago. If you wake up one morning and you see your portfolios are down, it's not a pleasant feeling. So knowing that you have some built-in downside protection through any type of market volatility is just one of those things where you avoid any type of catastrophic risk and you might be able to sleep easier at night.
Yeah, no, that's amazing. And what I think is great about the secondary funds and investing in private equity and diversifying that way is we were talking earlier about the entrepreneur who's so heavily invested into themselves and so heavily invested into their business. A lot of times with private equity, it's something that an entrepreneur, CEO, operator can wrap their head around, because we're talking about managing businesses and it's something that I know a lot about. Whereas if we're talking about some, overseas oil project, it's just so far outside of my head. I'm like, I don't know what we're doing, or it makes me feel a little uncomfortable. But as an operator, I've always looked at secondaries, especially in the private equity market, as something that I feel like I can understand a little bit more as an operator in my businesses. And as an investor, I can go, okay, I think I understand what's happening here.
Exactly. And that's an important thing too, in terms of knowing what you're invested in and why you're invested in it. You're helping these other guys who are in a similar spot to you're in, and you've probably had moments where you needed access to some extra capital, and knowing that you're backing these other people who, they're in a similar arena that you're in, fighting a similar fight. It's one of those things. It's an investment that's pleasant to own, not just that it's performing well, but it's serving a nice purpose and it's helping other people out to, fight the good fight and in private enterprise, add
Yeah.
value to different marketplaces.
And it's something that I don't know exactly if it was Charlie Munger or Warren Buffett that mentioned it, but the philosophy of just investing in things that you think you understand. It's a very simple philosophy. It's like, I understand bubblegum, I understand the railroads, I don't understand Facebook, so therefore I'm going to make my choices in things that I understand. Now, I don't think that's a wide investment philosophy for everybody, right? It kind of goes back to having diversification, and right, can't only be things that you understand, because there's a lot of things out there that you may or may not understand. But I think starting from a level of comfort, that's an easy place to start. What other opportunities to diversify are there?
All right. Well, I have one more slide I'm going to show here. This is from a proprietary trading desk called Game of Trades. Why are we looking at this M2 money supply? And to break this down, what we mean by the M2 money supply, this is a central bank measure of how much liquidity is in the system. So when they started raising rates in, after 2021, 2022, when inflation became so problematic, it tightens the monetary supply to where what we say in the business, or I don't know who says this, but we call it when money goes to money heaven. It's like it's this concept of, well, where did it all go? And it's when credit becomes more challenging to access, just it starts to have less velocity going through the market and it doesn't resurface until this trend has shifted back in a positive direction to where now, as rates start to come down, more money is being injected into the system. And that can be dollars, euros, whatever it is. The point I want to make about this is a pure play on the expanding monetary supply would be Bitcoin. And I'm not one of these people, like Kathy Wood will show up on CNBC and make like a $14 million is my bearish case. It's like I don't know what type of calculator she's using. If that works out, great. I'm not one of these guys who's going to go all in on Bitcoin, but I do think, let's say I'm in a 60-40 portfolio and I want to start carving out some other slices here. I can go 50% S&P 500, 30% investment grade debt and government bonds. So I have now 20% that I can work with here. Maybe I'm just doing a couple percent into Bitcoin. And it's, 5% into the secondaries, 5% into real estate. Like I said at the top, we're just doing a little bit at a time. We're going on the different stepping stones toward diversification. So I'm not trying to make the pitch that we're going all in on Bitcoin, but as a pure play of more money coming into the system and Bitcoin tracking like a sponge, it's like a magnet to absorb some of the excess liquidity. Maybe Bitcoin is one that's going to perform well. And one more point on that topic, central banks aren't really in the business of easing the money supply out of the goodness of their heart. And what I mean by that is they're doing this in response to economic weakness. Economic weakness is something we would expect to see reflected in the share price as earnings decline. So you can see the money supply increasing, but the value of stocks decreasing. And in that case, we would want to have something that is going to benefit favorably from monetary expansion. And we might think, maybe having 1 or 2% exposure to Bitcoin makes sense for that reason.
So we covered some pretty interesting territory, opportunity zones, secondaries. We talked a little bit about Bitcoin and crypto, but what about runner-ups? Are there any runner-ups out there that come to mind?
Yeah, there are quite a few honorable mentions. I could start just because I'm looking at it. You can't see it, it's off screen. I have an original Monet that's been in the family for a couple of generations. I don't ever plan on selling it. I don't even know what it's worth, but it's good to know. Things
Mhm.
like that, they hold their value over time. So art has become popular, and it has been another one of these types of investments that's been democratized, where you can go on a website these days and you can pool funds together to just say, I want to have French Impressionist paintings, and you can just type in 10,000 bucks and then you can see how that performs over time. So that's a cool one. Another one that comes to mind, I have a friend over in Kentucky, and he has almost all of his wealth in the two strangest things. You wouldn't even believe it, but he has a collection of brown liquors. So he's got some bourbon, some scotch, some whiskey, and it's the sort of thing. It's not like walking into a CVS. When you go into his liquor cabinet, it's these things you never heard of them, and it's like when you see something valuable, you look at you're like, oh, okay, that's worth some serious money. So that's worth quite a bit of money, and I this always amazes me. He helps breed racehorses that go on to win in competition. I don't think he's ever had one that won a Kentucky Derby by any means, but he's had some serious racehorses that have performed well, and they're worth like 10, $20 million because of the offspring that they can produce and the money that these horses can generate out on the racetracks. So
Wow.
those are two that I like to talk about just because it's mind blowing to know. There's a lot of different industries out there that you wouldn't expect that are generally going to hold their value over time.
Yeah, that's really interesting. And it's no surprise that it's in Kentucky, bourbon and racehorses. That seems to make sense.
That's right.
And yeah, there's a big trend right now. There's been a trend of fractionalized shares of,
Hmm.
you mentioned this at the top. You mentioned the Monet, getting into precious metals and just collectibles and things of that nature. What other alternatives out there just come to mind as to kind of as we close this thing out that people should think about or could be thinking about when they really start owning the diversification conversation?
Yeah, it's a broad conversation, and I think it's important to highlight again that we want to start with where you're at, and then to try and develop a strategy over time, because we're not trying to get rich quick. What we're really trying to do, this central idea of diversification to avoid being over concentrated in any one thing. It's important just to get started, start working with your inner circle, your advisors, your wealth management team, and just start somewhere, because there's a lot of different things you can own that are going to help insulate you from risk over time. And then you can get as sophisticated as you want. You can start using hedging strategies, and you can start, working with a hedge fund, or you can, there's a lot of different sophisticated tools you can use. But really, the main idea is just find different investments that generally have a deviation in how they correlate with one another, so that you have the opportunity to rebalance when the time comes. And then you'll start to really be able to track that your portfolio is doing better over time than just the passive strategy, or by not doing it at all.
Wow, I love it. Yeah, you dropped a lot of knowledge here, and thanks for sharing those slides. Very interesting. If someone wanted to diversify or have a deeper conversation about this, how does someone get a hold of you?
Yeah, well, what we do is we post a lot of static content where you can just go and look at what we would say is a quote unquote model portfolio, where we would say, you're 60-40 right now in these traditional assets. Let's make it, 50, 30, 10, 5, and 5, or something like that, where you can get an idea even just without messaging us directly. But if you do want to get into the weeds, and these are conversations we love to have, and we do it on a complimentary basis. And yeah, we're very accessible. These are conversations we're happy to have. I think I've mentioned it before in some of our previous content. We like being able to support people that are in private enterprise, because it can be a lonely, complicated journey, and anyone who's helping out your team, and when you have a professional going to bat for you with these other items you might not have expertise, we're happy to be that point of contact for you.
Awesome. Well, thanks for joining the show, and we will see you all on the next episode. Thanks.